Hi there, pro traders, and welcome to yet another training session here at GoPro Trading Academy, where today what we're going to be talking about is how best to measure risk in Forex trading. Now, before I jump into it, I appreciate you being here. Please make sure to hit that like button. And if you haven't yet subscribed to our channel, please make sure that you do, because we bring out high quality professional training like this on a regular basis. And make sure you hit that notifications bell so that you can be advised as soon as it comes out. All right, so risk management and measuring that risk is an essential skill that you need to have as a trader, especially as a Forex trader. It's one of the things that helps in many different ways, but obviously if you can't quantify your long-term risk in trading, it means that you probably have an unacceptable level of risk. And you really are just winging it and relying on luck for your future survival. Now, that's one of the reasons that so few people do make it in this great profession, which is awesome for those of us who do survive, because, of course, this is a zero-sum game, and all of our profits have to come from somewhere, and that somewhere is called losing traders. So my goal here is to try and help you to not be one of those, and being, first of all, aware of the risk you're taking as a trader, and secondly, knowing how to measure it is absolutely essential. All right, so let's jump into this. By the end of this session, there are a couple of things that we want you to have fully under the belt, properly assimilated and understand. First of all, you need to know how to measure risk. That is absolutely true, and what the ways of doing that are. But you also need to understand where that risk comes from. Now, this session is not primarily focused on that. We could do several hours of training on that, of course. But if you don't have some kind of idea of where the risk comes from either, then likewise measuring it there's not much point to that either. Because obviously in measuring it, what we're trying to do as well is minimize it. Okay, so what first of all then are the sources of risk in your trading? And we could actually list a couple more, but these are broad categories, I think, which cover the bulk of everything. And if you look this up online, you might hear people talking about these categories slightly differently. But nevertheless, you'll see that they're pretty straightforward. First of all, systemic risk. That's normally stuff that you've got no control over. So it really is acts of God. It's about what happens if the banking system were to collapse, and so on. So there are definitely systemic risks out there. As a rule, as individual traders and retail traders, as I say, there's not that much that you can do about it. And it's one of those things that you have to accept as a trader. Secondly, though, you've also got infrastructure risk, and this is something that you certainly do have control over. And it really comes down to such simple things as ensuring that you've got a good internet connection, power, you've got a decent machine that you're doing your trading on, and so on. So that's pretty straightforward. It's not that difficult to achieve. And certainly for those of you also who are part of the Academy, you know that especially when you start using our tools, we advise you to take advantage of a VPS, a virtual private server, which helps to alleviate a lot of that risk. Then thirdly, we have what is called strategy risk. And this is something that most traders get wrong. The problem with most strategies is that they're not profitable. But then the second biggest problem with strategies is that even those that are profitable, the majority are only profitable in the short to medium term. Another way of putting that is that they are very fragile. They are fragile to potentially systemic risks as well. So market shocks and things like that can cause a fragile strategy to break. So even though it appears to be profitable in the short to medium term, sooner or later, it will cause you to lose all your money. And there are plenty of strategies out there that are like that. They also play into the trading psychology of most traders. So in order to be a long-term successful trader, you need to understand the difference between strategies that play into our weaknesses and those that play into our strengths. So if you are using a fragile strategy, it will feel better in the short term to trade it. Whereas if you're using what's called an anti-fragile strategy or a convex strategy, then typically it's more difficult to trade in the short term, but ultimately those are the most profitable and successful strategies. So now understanding trader risk is also very important, because in fact, this is probably the biggest risk that you face as a trader. And it comes down to you being able to control yourself. Now, if you spent any amount of time trading, then you know some of what this is all about. You understand the emotional highs and lows that come with trading, and you know what a battle it is to control those. You know what a battle it is to remain consistent in your trading, consistently doing the right thing, especially when it doesn't feel like you want to. And the inability to do that is, of course, a significant risk. And that comes down to breaking the rules of your strategy. It comes down to removing stops altogether or adding to losing trades. There's so many different things that traders do to sabotage themselves. All right, so that is a massive topic on its own, and we've got plenty of training on that already. But moving on to the final risk that we need to be aware of, and of course, that is market risk. Now, a lot of people might say, isn't that systemic risk? Well, not necessarily. Market risk is really just the nuts and bolts of availability of liquidity within the market. What happens if there's a significant news announcement that comes out, or a historical event that can affect the markets? We look at that separately from systemic risk, because it is something that happens on a day-to-day basis as well. It is also quite closely tied into strategy risk. Right, so those are the main sources of risk. What we're going to be focusing on today, though, really is just the overall risk of your approach to the market and how to measure that, which of course is a blend of all of these. Now, we're also going to assume that your trader risk is taken care of. And likewise, we're generally going to assume that systemic and infrastructure risks are not an issue. Although systemic risk, as I say, is something we need to always just accept. But infrastructure risk, I'm assuming that you've taken care of that. So we're really looking at the combination of market and strategy risk on a longer term basis. All right, so having spoken about that, let's understand what risk is actually all about. When we come to measure it, what do we care about? And this is something that most people get overly complicated about. But it is absolutely simple, because the only risk that really matters to us as traders, and even if you're an investor, is permanent loss of capital. Why would you care about anything else? Of course, we understand in trading that we have volatility in our trading. We understand that there are ups and downs, and we need to be able to go with that. We need to be prepared for that. And of course, that's what we're going to be talking about partially today as well. But the true risk in trading that we care about is permanent loss of capital. And again, if I come back to those sources of risk, then we go back one, but you know, what the biggest problem, the biggest cause of permanent loss of risk, the most common cause of permanent loss of capital, I should say, is trader risk. So just remember that you are generally going to be your own worst enemy when it comes to trading. All right, so permanent loss of capital really is the number one thing that we care about. So the next question you might ask is, isn't that just extreme volatility? And a lot of people will conflate or equate volatility with risk. And this is why I say we need to be careful about how we define risk. And if we start off with the point of view that it's volatility, then our future behavior is going to be very different than if we start off with the understanding that true risk is the permanent loss of capital, or the risk of permanent loss of capital. So is it extreme volatility? Well, no, because volatility works both sides. Let's have a quick look at that. On the one hand, a 100% drawdown would mean loss of capital. And once you're out of the game, that's it. So yes, it is true if you're talking about extreme downside volatility. Not only that, but it's tied into the trader risk. If you suffer losses on your account that you are not psychologically prepared for, you are very likely, in fact, almost guaranteed, to start exhibiting behavior that will cause the loss of the rest of your capital. And for those of you who have blown accounts, you know exactly what I'm talking about. But the answer is also no, because volatility works both ways. We also have upside volatility. And I'm sure you'd agree with me that if I was to say to you that tomorrow you're going to have 20% upside volatility, you would have absolutely no problem with that. So we don't mind upside volatility. In fact, that is, of course, where our positive returns come from. The issue really is with downside volatility. So we want to really look at measuring the downside volatility and being aware of what causes that. So let's focus on that, and also let's look at how the different ways of measuring risk deal with this challenge of understanding that volatility works both ways, but in reality, we only care about downside volatility. Another thing with measuring our performance as traders generally, but in particular with measuring risk, is the use of averages. And you're going to see how this is a major problem, especially with the most common metrics that are used in the investment world when it comes to measuring both performance, trading performance, and investment performance, as well as risk. So really, folks, this is an important thing to grasp. We do not and we should not equate volatility with risk. However, downside volatility clearly is associated with risk, and we need to bear that in mind. Right, let's have a look then at what these metrics are. So the subject, obviously, of today's training is, in fact, how to measure risk. Now, what we're going to be doing is looking at not just risk, but also performance. So how do we best measure trader performance? And not taking risk into account is actually one of the biggest mistakes that even professionals make. Even at an institutional level, this is very often something that is done wrong. Right, so the first and by far the most common measure of trading performance, including risk, is the Sharpe ratio. What is that? Well, I'm not going to get into too much detail on this, and you can look it up easily online as well. But just as a brief description of it, what the Sharpe ratio is, well, first of all, it is a ratio, and it measures the average long-term return over the average volatility of that return. So we have an average return over time, and of course, sometimes we're going to have a higher return, other times we're going to have losses, and we have that that volatility around that average, around that mean. So if our average return, for instance, is let's say 5% per year, and I'm just looking at potentially a stock market return, or even 10% per year, and then we have a volatility around that of sometimes it will be 20%, other times it will be 10%. What we do is we work out the standard deviation of that volatility. And one of the biggest problems with this is that they use a mean or a Gaussian distribution measure for that. So if you're working out the standard deviation of something, it is a type of average. That's the problem with it. Now, standard deviations work very well in the physical world, such as with the heights of people and so on, but they don't work very well in the information world. And this is one of the biggest problems that even that has caused some of the biggest trading losses ever in history. Long-term capital management is one of the examples I always use. I was around at the time in 1998. I was actually a relatively young professional in the city of London when long-term capital management blew up, taking billions of dollars of investor funds with them. Well, one of the problems that they had is they were relying on standard deviations to measure volatility. The issue with this is that the hidden risk are the unforeseen events, something that people assume won't happen, and they say like a 6 sigma event. That means the probability of that is 6 standard deviations away from the mean. In other words, it's only going to happen once every 10,000 years or more, when in actual fact, events like that happen more than once a decade. So that's the problem with using standard deviations. Another name for these events is called fat-tailed events. So that's a whole nother topic as well. But the point being is that the Sharpe ratios are actually pretty useless when it comes to measuring risk, certainly, and even when comparing different investments, which, as I say, is ironic because it is by far the most commonly used measure. Next up is what is called the Sortino ratio. Now, why is this better? Well, what the Sortino ratio does is take one step uh, further than the Sharpe ratio, and it cuts out upside volatility. So the Sharpe ratio, for instance, is, I mean, if we had, if we had a trading strategy that gave us significant upside volatility whilst restricting downside volatility, that would be a very, very good thing. I'm sure you'd agree with me that if now and again I get massive big jumps, upward jumps in the equity of my portfolio or of my trading account, and now and again I only have small drawdowns, well, that would be a very good thing. However, the Sharpe ratio would measure that as bad because of that significant volatility on it, ignoring the fact that it's upside volatility. Now, the Sortino ratio does away with upside volatility, and it only looks at downside. But what it still does is it averages it out. It averages out those downside volatilities. And I keep saying to people that the average it's a murderous number. An example that I've stolen from, I think, Nassim Taleb in his book, Fooled by Randomness, is, we ask ourselves the question, would you cross a river, assuming that you don't know how to swim, would you cross a swift flowing river that is on average 3 feet deep? And most people would say, sure, why not? I'm about 6 foot tall. I could easily cross a river that's on average 3 feet deep. Well, no, the problem is that the middle of the river is 10 feet deep. So the average includes the shallowest portions around the sides, but it also includes that deepest part, but it doesn't reflect the fact that the deepest part of the river is 10 feet deep. Likewise, if I have an average drawdown of let's say of 10%, which is the kind of metric that the Sortino ratio is going to use, well, that doesn't tell me anything useful if the vast majority of them are only 1%, but there's one in there that is 100%. Because all it takes is 100% loss for me to be completely out of the game. So that doesn't help us either. And that takes us into the third and the only really useful metric, which is called the Kalmar ratio. The Kalmar ratio is taking the average return, which we don't mind. We don't mind the fact that we measure returns on average. The only thing we must be careful about is measuring risks on average. So we look with the Kalmar ratio, we look to identify the maximum drawdown of our approach to the market, be that a strategy, be that an investment process, whatever the case may be. We need to be able to identify the maximum drawdown of that over time. So it's a very simple ratio, much easier to calculate, in fact, than both the others, and also more useful. So you take average return and you divide it by the maximum drawdown. But there is one problem with this we have to point out, and that is, how do we know what the maximum drawdown is? It is always pretty safe to assume that the worst case scenario is still ahead of us. It's like that with everything. It's a mistake that insurance companies make. We need to be aware of the fact that the worst earthquake that has hit the world in living memory or in human memory has not yet happened. Likewise, the worst hurricane, etc. So the worst drawdown that your account has experienced has yet to come. And there are statistical ways of modeling this. Certainly, if you understand the statistical nature of your strategy, then you would have an ability of estimating this. But even then, we just simply take if we're being careful about this, we make sure that our maximum measured drawdown is no more than 50% of what we are comfortable with. In other words, what we assume that the worst case scenario is going to be double what we have seen to date. Also, when I say what we've seen to date, you need to have some experience with that. That is also the problem for somebody starting out anew and afresh with a new strategy, is how do you actually get any idea of what that is? Now, backtesting certainly can help with that as well. And we always recommend that people who are trying a new strategy backtest it properly. If you're getting a strategy from somebody else, they need to be able to tell you how many trades they've taken, what the average return is, and of course, what the maximum drawdown over that time period was. Now, there is another way around this, folks, And that takes us back to strategy choice. And it is something that we talk about in our other training. But if you use a convex type of strategy, one which by its very nature looks to limit downside and seeks to maximize upside, and which shows asymmetry as far as that's concerned, then you are likely to ensure that your Kalmar ratio is not only maximized, but you are minimizing the probability of a maximum drawdown that is well beyond your expectations and therefore what you're able to cope with. All right, so the Kalmar ratio really is our chosen metric. What none of these are, it has to be said, first of all, as I've mentioned, an average. Although it has, I suppose, the Sortino ratio and the Sharpe ratios do use averages, which is why we don't want them, but certainly the Kalmar ratio is not an average. We don't mind the fact that the return is averaged out, but that also reflects the fact that that is important. The average positive return is what is important to us, or average return over time. That is important, but there is a qualitative difference between upside and downside. A lot of people say, well, there's no difference to me if I make, $10 profits compared to a $10 loss. There's no difference in the positive reaction compared to the negative reaction. First of all, that's completely not true. The human brain reacts very different to losses compared to what it does to gains. We are likely to experience a negative emotion that is 2.5 times stronger than the positive emotion with an equivalent loss compared to a gain. So we certainly look to take that into account. But there's an absolute fundamental and even philosophical difference between upside and downside. And that is evident in the extremes. So if I was to say to you, right, well, today you're going to make a 10% gain on your account, or this month you're going to make a 10% gain on your account, is that qualitatively the same to the upside compared to, let's say, a 10% drawdown on your account by the end of the month? And the answer again is no. There is a qualitative difference. And the bigger the loss, or the bigger the number, I should say, that we're comparing here, the more apparent that becomes. So it is most obvious if I was to say, well, is there a qualitative difference between 100% gain and 100% loss? And the answer, of course, then is obvious. 100% gain would be very nice. We like to have that. And over time, certainly we do experience that. But 100% loss is absolutely unacceptable, because it means you're out of the game, probably forever. Most traders who experience that with significant capital never come back to trading ever again. And probably quite right too, because they didn't learn the lessons that they needed to in order to ensure that that did not happen. All right, so we don't average out the losses. That's the most important thing. We look at the maximum drawdown. So that's very important. The second thing that this metric, the Kalmar ratio, is, of course, it is a ratio. It is not a percentage return. It often amazes me how a lot of traders will be very proud of the fact that they've made an 8% or 15 or 20% return in a month, whatever the case may be. Nice, big, positive numbers. And that's it. They don't look any further than that. And why is that important? Well, because the percentage return that a trader makes in any period of time ignores completely the risks that they took to make that return. All risk is ultimately hidden until it happens. So in other words, if someone is only focusing on their percentage return and how much money they're making as a percentage, then it means that they are living by luck, and it is only a matter of time before we no longer hear from them ever again. So percentage return on its own means nothing. You need to know what risks you are taking and be able to measure those risks in order to be able to have an understanding of whether that return is good or not. And of course, that is exactly what the Kalmar ratio does give you. And finally, of course, what this is not is an absolute number of anything. When attending and being invited to do training for traders, especially beginner traders, which is I've done several times over the last decade or so, I've often found that people will want to come and talk to me about how many pips are made in a day or a week or whatever the case may be. You see this in many discussions online as well. And that, of course, is an absolute indication that you're talking to a rank amateur. If that's you, well, you now have more information to help you to move away from that. But if you're listening to somebody else or talking to somebody else who tells you about how many pips they make in a period of time, you need to run as far and fast as possible, because that means even less than percentage return. It is even possible to have made a positive number of pips in, let's say, a week and still have actually lost money. If you don't know how that is the case, then you need to recognize right now that you don't know and you need to find out. If that's something that you're keen for me to talk about more in the future, happy to do more training on that. So please just drop into the comments below here. More training or just say more training, that's fine. If you want to specify any parts of this video that you want me to spend more time on, then you're welcome to do that as well. All right, so it is really, really important to understand what we're not doing here as well as what we are. All right, so I've mentioned the qualitative difference already between positive returns and drawdowns and how essential that is to know and to recognize that there is a big difference between, let's say, a 10% account growth and a 10% loss. You'll even notice this in your scaling. So if you have, let's say, a $10,000 account and you risk 1% on a trade and you lose that trade, as you know, you'll be down to $9,900. If you then take another trade with 1% risk and a 1% target, and you win that trade, are you back to where you were? Are you back to $10,000? And the answer is actually no, you're not. You're just shy of that. And this is ignoring trading costs, folks. This is even ignoring trading costs. So that is even visible there. So if ever you've traded a strategy where your potential gain is the same as the risk, if you're risking 1% to make 1%, then you will have seen that this is true already. And again, a convex strategy, which is so important for you to use if you're going to survive long-term, will also help ensure that that doesn't happen. Right, so these folks, remember that qualitative difference, absolutely essential to know that in your trading. Right, so finally, before we wrap this up, what is a good number if you already are able to measure your average return over time, and you also know over a significant period of time what your maximum drawdown was? Well, if you look at an investment point of view, and if you were investing in ETFs and so on, if you've got a portfolio of investments, then a 0.5 CalMAR is actually pretty good. So that would represent the fact, let's say, if over time you are getting an 8% return on your investments, which is pretty typical long-term for the stock market over the last century or so. If you've got an 8% long-term, but there was a maximum drawdown of 16%, then your CalMAR is 0.5. So if you are a long-term investor in the S&P 500, then, well, you will know what happened in 2008, where we had a 57% drawdown on the S&P 500. So in order to have an annual CalMAR on the S&P of 0.5, it would mean that your average annual return would need to be in the region of 28.5%, which clearly it would not be. Maybe you've done extremely well in the last few years with all the money that's being pumped into the stock market, thanks to the Fed printing trillions and trillions of dollars. All well and good, but remember, if you are using this metric, then unless you've achieved around the 28% average annual return, you haven't even got a 0.5 CalMAR. So if your average annual return on, let's say, S&P is around 10%, then it means that your CalMAR is still under 0.2 with that maximum drawdown of 57%. All right, so that's investors, but for most of us, this is about trading and Forex trading. It's a little bit different. We are also, we have a lot more control over some of the risks. Market and systemic risks affect things like stock markets more than it need affect us if we are using the right kind of strategy. So we should be aiming to achieve a CalMAR of at least 1. So if you're making a, and by the way, we also measure our CalMAR more likely on a monthly basis as Forex traders as well. So it's the long-term average monthly return. So if you are making an average of 10% a month with a maximum drawdown of 10% over the longer term, then you're doing pretty well. So that's kind of the target that we are looking for. The longer you trade, the harder it is to achieve, because you only need one really big drawdown, but it's in order to obviously affect that number quite significantly. But what this does, rather than being something for you to aspire towards, what it forces you to do is evaluate your approach to the market and ensure that the risk of big drawdowns is minimized. And folks, that's why this training is all about risk measurement. Even though we also talk about returns, those returns are all generated as a result of taking risks. Most risks that traders take are hidden from them. You need to make sure that you understand what those risks are and ensure that you alleviate them as far as possible to minimize that maximum future drawdown, because it is going to happen. That's how the only 1 or 2% of traders who survive do survive. They focus on the downside, on minimizing the downside, and they pretty much let upside look after itself. So folks, that really helps me to wrap this up then in conclusion, to remind you that the source of risk is what is really important here. If you are not thinking about the sources of risk in your trading, that means you're not measuring them. And if you're not even trying to measure them, you're not managing them either. So be aware of what those risks are. Take all the steps you can to understand what they are so that you can then manage them. And once you're doing that, make sure that you're also measuring how well you are doing with that. If you aren't measuring it, it doesn't exist. Right, folks, so I hope this is useful training for you. It is an absolutely essential topic. If you would like me to spend more time on any area here, I'm happy to do that. So in the comments below, just please put in your request for more training and specify if there's a particular area you'd like me to cover. And again, if you're really enjoying our material, and I hope that you are, make sure that you hit that like button for this video. And if you're not already a subscriber to our channel, do subscribe and don't forget to hit that notifications bell. All right, folks, well, that's it from me. I look forward to chatting to you guys soon. Remember, member training tomorrow, and then I'll see you all again for our market review on Monday. Have a great week further. Bye for now.